Gold saw its biggest single-day drop in weeks today on Friday as the yellow metal retreated $40 at the morning bell at 8:30 a.m. Eastern Time. We're speaking with Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Gareth, welcome back to the show. Tumultuous day for the gold markets. We're down about more than 2%, 2.3, 2.4%, depending on the price you're looking at. It's a significant move for gold. So welcome back to the show. I'm excited to talk to you about this.
Yeah, thank you for having me back, David. It's always fun with you.
By the way, you're moving. I see you're only down to 3 screens behind you. Where are your other 5 screens, Gareth?
So I just picked up a U-Haul and I'm just about to pack up and we're moving cross country back to Florida. So that's why it's kind of the light version of my setup right now. It's kind of the on-the-go mobile setup.
Okay, well, you're still every bit the legit trader you were. You don't need 5 to 8. You don't need 8 screens to be a legit trader. 3 is enough for you. We all know that. You know what else is on the move today? Gold. So let's talk about that. Why the drop today? It just came out of nowhere.
Yeah, so what we saw was a tremendously strong jobs report, better than expectations, and that caused the GLD and gold to really fall off a cliff here. Now, one of the things that's important to understand is that when you get a situation, there's 2 catalysts to gold in the positive or negative direction. One is inflationary pressures. Now, inflationary pressures, if interest rates go up because of inflation, gold is going to rally. Now, today was the other one where interest rates rallied on the back of a strong economic number. Economic numbers showing strength historically have caused gold to drop. So my thought process is that this is just a short-term drop as the economy looks to be strong or stronger than expected. And make sure you understand that later on, whether it's at the end of this year or 2022, once you see interest rates going up because of persistent inflation, that's when gold will really see the upside with interest rates.
So you're saying today's drop was overextended?
Well, it's just more that the rally, so there's usually a negative correlation between interest rates and gold. So when interest rates go up, gold goes down. And that's the way it's been for 20 plus years because we haven't really had any inflation. So it's been interest rates up when economics are strong. And again, that's the situation we have today with a good jobs number is causing interest rates to go up. So you're seeing gold fall. On the other side, later in the year and next year, my guess is you'll see interest rates going up with inflation because of inflation pressures, and that will yield further upside in gold.
That's interesting. So you're saying inflation has a stronger tug on gold than interest rates?
Yeah. And you can actually see this. If you go back to the gold price, if you go back to the 70s gold price and so forth, you can actually see this movement with the inflation, which is really, really fascinating. So it's definitely worth just taking a note. I know everyone has such a kind of a micro view on charts over the last 5 or 10 or 15 years in the terms of cryptocurrencies. It's over the last couple of years. But if you look at a larger picture, you actually do see that correlation play out.
Okay. Well, if you can pull up a DXY index, we can take a look at that. Significant strength on news that the jobs report was strong. I'm wondering if that is correlated again to interest rates.
Yeah, so definitely it shows an economic strength here in the United States, which is a positive, right? So anything that pushes interest rates up, which is the economic news we got today on the jobs report, is going to create a scenario where the dollar gains strength, right? It means the Fed is going to print less money. The government is likely going to print less money as well. And it means that we're on a stronger footing. So you're getting a little bit of an uptick here in the dollar today, according to this UUP chart, which is the dollar ETF bull. And again, that should be expected in the near term. Now, remember, near term, you see a lot of choppy action on the dollar here. What's important to understand is that near term, you could go a little bit higher. You even have this kind of W pattern with a V formation, which is a bullish formation. But longer term, remember that the printing of money will eventually take its toll and you will see the dollar come in. So whether it's, if you have, if someone came to me and they said, hey, what's a 5 to 10 year outlook on the dollar? It's much, much lower, especially with the China yuan, the digital currency there looking to take over as the reserve currency. But in the short term, there's no doubt that the dollar can gain some strength.
Okay. You know what's interesting today is that the S&P 500 didn't go down. In fact, it went up slightly. So
yeah.
Equity investors are digesting the strong jobs report as good news. Now I'm thinking this could just mean that the Federal Reserve is less likely to keep rates low because why would they need to anymore? Shouldn't that be bad news for the markets? Shouldn't good news in this case be bad news? But that's clearly not the case.
Yeah, so this is a very interesting point, right? So if you look at the S&P, the S&P's up a little bit. Why? Because people have more jobs, the reopening trades, the Las Vegas Sands, there's these other stocks that have really been beaten down. I mean, if you look at LVS just has gotten crushed because of the Delta variant, right? So the fact that we're seeing more people with jobs, the economy stronger, you're seeing a lot of the S&P components doing better. Now, if you look at the Qs, right? So take a look at the QQQ. What's the QQQ doing? The NASDAQ 100 is actually dropping 0.5% today because, again, the higher interest rates go, that's more negative for technology, high valuation stocks. So, again, there's this little disparity, this money flow price action that we're seeing, and we've seen this for the last couple of months, is generally when interest rates go up, you see certain stocks benefit, generally the ones in the Dow and the Russell and the S&P. And then when interest rates fall, the NASDAQ components like Apple and Google and Amazon, they take over with pushing to the upside.
Okay, so we've talked about this before, topping action for the S&P 500. What's the trend right now? Are we still, this wedge formation right now? We're close to convergence, I see. Close, but not quite.
This is so amazing to me, David, because I just love charts and trend lines and something. And basically what you can see is that and I've talked to you probably for the last 2 or 3 times about this converging wedge pattern on the S&P, and we've peaked below twice, once here and once here, and you've never gotten that secondary flush through. So to me, that's just games by the big boys, the institutions, the algorithms trying to tease us, essentially trying to get us to jump on the short side of the market before it really has proven itself that it has broken down. But the one thing you can say here about this wedge pattern is that those lines are converging, which means I would dare say in the next 1 to 2 weeks, you are going to either get a breakout or a breakdown of significance. And that I don't know for specifically which one it's going to be. But at some point in the next week or two, these lines are going to converge, and it's going to force price out. So, I've said this in the last few days, but basically look for something major in the next 1 to 2 weeks, and maybe we can have another interview in about 2 weeks and just look and see if something happened. But something's going to happen here that's going to either cause a dramatic spike to the upside or to the downside.
Or maybe another strong economic data release. Who knows? But let's go back to gold. People want to know what you think about gold now. We've talked about what has happened, what's going to happen next. Let's just take a look at the technicals right now. What's the next key level for you?
Yeah, so gold definitely breaking down over the last couple days. Now, the one thing to recognize is you haven't taken out this short-term low. You've just touched it. So that is technical support. I do think gold could go a little bit lower in the short term. There's another level just below here with this little pivot high, and that's going to be very significant support. Now, there is a pattern that I'm looking on the charts that's a bigger pattern that I'm following, and this is kind of my bull case into year end for gold as well as into 2022, which is an inverse head and shoulder pattern. So you can clearly see a shoulder here, head and shoulder. Now, to trigger, you have to get gold to take out this trend line. Once it takes that out, the GLD will go above 200 and pretty much, I wouldn't call it a straight line, but within a short amount of time over the course of a couple months, you could see a dramatic move up in gold taking out that level. So again, short-term choppiness, maybe a little bit of short-term downside. I'm still bullish on gold. Even if the technicals weren't involved, even if you didn't have this head and shoulder pattern. And remember, the head and shoulder pattern is within a longer-term bullish consolidation pattern here from this move up. But even if that wasn't there, you just have to have this long bias on gold over the longer term because the printing of money is not going away. The government is going to continue to rack up debt. There's so many negatives over the longer term, including what I mentioned on the dollar, that is going to drive the dollar lower, which will also put pressure up to the upside on gold.
Short term, though, Gareth, are we done our descent for gold?
I honestly think there could be a little bit more. I don't think a lot, but this is kind of a trend line I'm watching on the GLD. On the GLD, this is at a price point of 163.70 to 65. So, we're at 165 right now. So that's another $1.50 down, maybe at maximum. That would be my guess of the downside before it kind of stalls out. But again, that's your short-term support, and that would be my guess. And if that does hold, you still have a higher low, and then a higher low right here to look for on the chart.
If you take a look at the past on that chart, wherever we've gotten big moves, it doesn't happen a lot in a single day drop, but it has happened a few times. Each time has been followed by not as significant, but somewhat of a rally. And then depending on what happens, we can either get a consolidation or a further move down.
Yeah, and
So
I think it's important to recognize, right, is that you see a lot of these bigger moves, and then gold does come back, and what that's showing you is that there's a buy the dip mentality in gold. My guess is institutions and wealthier investors, as well as smaller investors, are seeing the same signals I do, and they may not be in the trading form, which is in and out very quickly, but they're
yeah.
saying, all right, listen, in the longer scheme of things, I want to buy the pullbacks on gold because I do see the 5-10 year outlook, which is very bearish for the US dollar and very bullish for gold.
Okay. Dramatic move upwards for gold. Let's just touch on that before we move on to another asset. Now, Gareth, what's going to trigger this dramatic move? You said in the next month or so we could see a dramatic move up. What would be the trigger for that?
Yeah, so remember that it's all contingent on when we break this neckline. So this is what we call a neckline, where you connect the kind of the underbelly of the inverse head and shoulder here, and it's at that point that would trigger the bigger move. So whether it's in a month or 2 weeks or 6 weeks, I'm not 100% sure, but that's the level I'm honing in on to watch for the bigger move to start. Once that triggers, it should be the big move. Now, what causes it? That's a great question, right? I mean, could it be more inflation than expected? Could it be a drop in the dollar? Could it be a slowdown in the economy where the markets collapse and people run to the safety of gold at some point? I mean, it's so hard to guess at what could be the catalyst. Usually I'm very bad at that guessing part. It's more the charts are what dictates the truth.
Okay, so it's not quite over yet. We'll watch for that. All right. Now, I hesitate to say that today is a risk-on day because not all equity indices have rallied. The NASDAQ is down 40 basis points. I'm looking at current market prices. So that's bad. I mean, S&P's up, we're flat. The Dow's up, but the growth sectors, NASDAQ, that's down. So I wonder what the sentiment right now amongst investors or traders, because if you're selling gold, you would think that, okay, well, they're just rushing into risk assets, but that's really not the case across the board right now.
No, it's definitely not. And again, it's amazing how so much of the market is being controlled by interest rates. And you can understandably, know why, is because the Fed has created this situation where the market is just addicted to low rates. It wants low rates because then these valuations can go to the moon. And any sort of change in low rates, like today where the 10-year yield is spiking pretty dramatically, does send a shockwave through high valuation assets like the NASDAQ stock. So that's exactly what's going on here. But what we're seeing today is important. It's important to recognize that you're not seeing an exodus, right? So you're seeing an exodus in technology, but the money's not leaving the market. It's rotating into kind of the low PE, higher dividend stocks in the S&P and the Dow Jones Industrial Average. So it's just a rotation right now. We haven't seen an exodus from the market, just from specific areas.
Okay. Well, on that note, let's take a look at this chart that you've tweeted. So this is some research that you've shared with your audience on Twitter. What are we looking at here? You've got a bunch of years starting from the 70s to the 80s. You've got the PE of the S&P in the second column, and then inflation on the right. So what's the relationship here, Gareth?
Yeah, so this comes from, people were saying to me, I've been saying that I'm generally bearish on the indices. I think the valuations are a little ridiculous. And they all say, well, markets are going to go higher because, inflation is going to create, higher risk appetite, and you got to put more money into stocks. It's going to drive stocks up. Valuations can get even more stretched. And so I said to myself, all right, this may be true. Let me do my research, right? And what I pulled up here, the mid 70s to mid 80s, you can actually see that the higher inflation, the lower the PE ratio. So for the S&P. So I think that's very, very important to kind of take a note on here, that it doesn't necessarily dictate that higher inflation will lead to a higher PE in the market.
Well, the PE, okay, I haven't, the PE could also go down because the prices of the equities have gone down, right? It could be because of a market correction. Could it not be?
Yeah, absolutely. So, I mean, that could be. But really, if you look at the market before 87 was our big crash, the markets were generally not doing that for this 10-year span. I mean, again, if you look at the S&P over that period, so it doesn't look like that's the culprit here. And to me, if you think about it, right, so everyone's like, oh, well, more inflation is going to yield, 20, 30, 40 times PE ratios in the S&P 500. But you have to understand that it doesn't quite work. It's not so linear. As inflation rises, what happens to companies, right? Their input costs rise substantially. So they are inevitably going to have more struggling and therefore their stocks you can actually look at that their stocks are actually going to come down in that situation in a high inflationary environment.
Okay. Well, let's put all this together for the audience now. Between equities and gold and silver, we haven't talked about silver, but again, big moves downward for silver as well. What are your favorite plays right now?
Well, yeah, I think we got to talk about Bitcoin for sure. So Bitcoin here, guys, so many people are asking me about Bitcoin, and this is a pivotal weekend for Bitcoin. So we can tell that Bitcoin's been in a trading range for really the last 3 to 4 months at this point. Today, it's pushing above that upper range. Now, most people are going to look at this and say, oh, it's a breakout, right? But remember, the games that the institutions play, they are plenty. Don't be 100% booked on a breakout here yet until you confirm above this candle. For me, I'd want to see a secondary close, whether it's tomorrow or Sunday. I want to see a close above today's high without going back below. If that happens, then it really tells us that there's not a game being played here by the institutions. And when I say games, I mean, whether it's on the spider chart I showed before where we traded below that line one day and then bounced back. That was a game. We did that twice. And even on the Bitcoin chart, you closed below 30,000. And what do? They lured in a bunch of shorts and stopped out a bunch of longs, and then they ripped it in the opposite direction. So yes, there's a potential move here in Bitcoin that could be a breakout, but let's watch to see what it does this weekend to see if it confirms. If it does confirm, then you're looking at upside to about the 48 to 50,000 level, this gap fill right there. So again, interesting stuff on Bitcoin. I got to just mention that because I think everyone's kind of eyeing this potential big breakout in Bitcoin.
All right, so what are you most bullish on, most bearish on right now? Stocks, Bitcoin, or precious metals?
Stocks,
Rank them
Bitcoin,
for us.
precious metals. I think if I had to choose, and a lot of people will disagree, but I'd probably go to the safety of I'd be long gold, short S&P and NASDAQ. And with Bitcoin, if you're in a very short-term trade and it confirms, a long to 50,000 before I reverse it back to expecting more downside. I still, by the way, just to be clear, because everyone will probably say, oh, now he's saying upside. So I still think we're going to net go to about 18 to 20,000. You're still going to see this overall deleveraging go on in the system, which will impact Bitcoin. So I'm looking at a shorter-term trade here if you confirm to 50,000 before you roll over and head towards 18 to 20,000 at the lows.
Excellent. All right, Gareth. Thank you so much for your update today. Excellent thoughts as always. Follow up next time.
Hey, thank you so much for having me again. Take care.
And thank you for watching Kitco News. I'm David Lin. For all those watching right now, good luck with your trades and follow me on Twitter at DavidLin_TV.